All right, let's get started. Hello, everyone, and welcome to today's TMA webinar. My name is Paul Kueber, and I am Managing Partner at Maybury Partners, where we focus on turnaround and restructuring of small and mid-market companies in operational improvement, turnarounds, and lender assistance. It is my pleasure to moderate today's webinar, Cryptocurrency, Is There a Future? We recognize this is a topic of great interest. We want this to be an interactive session, so feel free to submit questions in the chat and we will get to as many as we can. First, I would like to introduce today's panelists. Ryan Gross. Ryan is a director at Getzler, Henrich, specializing in providing turnaround and restructuring support services to distressed and underperforming companies and municipalities, as well as advising boards, management, and creditors. Ryan has served as an interim CFO, controller, treasurer, and advisor for clients in the automotive, manufacturing, retail, and financial services. Next, Ron Spinner. Ron is a principal at Miller Canfield's Insolvency Practice Group. His practice includes all aspects of bankruptcy, though he specializes in bankruptcy litigation, including preference and fraudulent transfer, prosecution, and defense. Ron has written 2 articles on cryptocurrency for the Norton Journal of Bankruptcy Law and Practice, Decrypting Crypto, Cryptocurrency Basics for Bankruptcies and Workouts, and Caution, Construction Ahead, Reworking the UCC for Cryptocurrencies. Next, Deb Kovsky. Deb is a bankruptcy partner at Troutman Pepper, resident in the New York and Detroit offices. Deb currently represents ad hoc committees in the Celsius and BlockFi cryptocurrency bankruptcies, as well as individual clients in FTX. And finally, Nick Ward. Nick is not able to be with us today as he and his wife are proud parents of a new baby girl born last evening. So congrats to Nick and his family. Next, I would like to thank our sponsors. Please remember that many of our events would not be possible without the support from our sponsors. So please keep them in mind when your next need arises. And just a quick advertisement on our upcoming events. April 19th is Comedy Night at Go Comedy. April 26th is a virtual power hour with TMA Chicago and Indiana. May 3rd is our annual Detroit award ceremony. And May 17th, an automotive update, opportunities and headwinds. All great events, and I hope to see you there. Now let's get started. First, the agenda. Ron will give an overview of the cryptocurrency landscape, including the hectic past year, legal changes, including the SEC and current issues. Then we'll dig into some of the bankruptcies and how they are being handled. Deb will give an overview of Celsius. Ryan will dig into BlockFi, Voyager, and 3 Arrows Capital. And I will finish the bankruptcy section talking about FTX. And finally, we will finish the discussion. We'll finish with a roundtable discussion on the future outlook. Again, please keep the questions coming. We hope to carve out some time at the end to go through some questions that have already come in. So let's get started. And with that, Ron, please take it away.
Sure. Thank you, Paul. Next slide. There we go. As we all know, there's been an interesting year for cryptocurrencies. A number of cryptocurrency companies have filed for bankruptcy protection. We've taken the liberty of bucketing some of the biggest ones here just as an overview. As you can see, this is a fairly significant number for any industry. The cryptocurrency bankruptcies are spawning various areas of cryptocurrency. One, the lending group. These are people or companies that raised money or raised cryptocurrency from some depositors and tried to help startups as they got out of the gate. And as you can see, starting with Celsius in 2022 July and Voyager Digital, there's a number of failures in that spot as weakness in the startups caused other of these lenders to fail. You have the mining failures. These are miners are the ones who make money producing the new blocks on the blockchain. They do it mainly for the Coinbase rewards, although in Core Scientific's both for the reward itself, and they also provided support services to other miners in terms of computer hardware and such. And of course, once the cryptocurrency winter started setting in and prices dropped, they were not only making less on their own mining efforts, but they were facing less demand from people who wanted to get into the space because there was not as much reward for it. So taking a hit on 2 fronts, that put them under. There's also exchanges that are filing, most notably FTX. This is probably more of a story of fraud than anything else, but nonetheless, a fairly significant failure to take place in November. And of course, you've got the hedge funds, Alameda being closely associated with FTX, and 3 Arrows Capital, which we'll talk about today, people who are trying to find places to make good bets on cryptocurrencies and whose bets did not turn out the way they would hope. Next slide, please. So now, if we were not short Nick, if Nick had not given birth to a beautiful child, we would have him here, and he would remind us, as he told before he told us he had to bow out, that we shouldn't be throwing the baby out with the bathwater. Nick is not one to say that cryptocurrency is without problems. He readily acknowledges that there's lots and lots of issues with it as it's currently implemented. However, there's lots of good still there, he sees at least, and it's our duty to make sure that we present from his behalf and not lose sight of the positives. So he pointed out that for the headwinds that the cryptocurrency faced, if you look at a year ago versus today, the capitalization of Bitcoin, Ethereum, and basically the crypto market as a whole has fallen by about half, which is a huge, staggering blow for any industry to face. And yet, despite all of this hard headwinds, the systems continue to work. Their marketing or the systems themselves are weathering the storm. I mean, Bitcoin has a hash rate now of 311 exahash per second. And just to put that in context, that's for the proof of work, that the exercises that the computers go through to make sure the blockchain is fundamentally sound. An exahash is 1 quintillion. So 1 quintillion hashes per second, 1 million hashes per second is an exahash, is doing 311 million hashes per second. Still, even in the middle of crypto winter, people are still churning away, keeping the blockchain working. About $850 billion has moved across 43 million outputs. Now, some of that could just be trading, people back and forth, just having fun. But some of that is also people actually generating economic activity, trading Bitcoin for some kind of value. So the chain is still there. And there's a growth of the Lightning Network. And as Nick would have talked to more in some detail about Strike, these are opportunities or things that are sort of piggybacked onto Bitcoin that make it faster. So you don't have to wait for blocks to mine to be able to transfer stuff. And in the case of Strike, to give you the opportunity, apparently, to liquidate Bitcoin on the fly from your account on a phone to say 7-Eleven. So you can actually use Bitcoin for day-to-day transactions, which gets closer to what Bitcoin was supposed to be in the first place, which is a cash replacement or certainly cash substitute. And as far as Ethereum goes, I mean, in the middle of crypto winter, they managed to merge, or they call it merge, but really migrate, if you will, from proof of work to proof of stake, which is a huge change to their underlying infrastructure, which they managed to successfully do despite all of the chaos. And they're still here. Most stable coins are still right now on Bitcoin, on Ethereum, 70 to 80% of it because of its enhanced programming background or built-in programming language. A lot of the stable coins, like I said, are there. A lot of the decentralized finance is there as well. 55 to 65% of stake value backing decentralized finance is still with Ether. About 952 billion in trading volume in 2022. And even in the midst of winter, Q3 2022 versus Q3 2021, decentralized finance was up in trading volume, up 45%. So there are still indications of life, and it's probably too early to write off cryptocurrencies yet. So we got to have that little dose of, it's still there in this before we start turning to looking at all the issues that are plaguing it, because that's where I think a lot of us are going to focus on today. Next slide. So this is where this is my normal back spot, but I would commend for those of you who were here for our last presentation, this one slide is a quick rehash, is that cryptocurrency for legal purposes is a lot of things. The IRS will tax it. It is property for tax purposes. It is funds for money laundering purpose, which means that if you can't do it with dollars, you can't do it with cryptocurrency. So don't go around trying to use cryptocurrency to fund terrorism or money launder or any of those kinds of things, because it's, if you can't do it with dollars, it's equally illegal in using cryptocurrency. If you ask the Commodity Future Trading Commission, cryptocurrency is a commodity for the most part, because if you think about it, anything not money that is interchangeable is a commodity. So just as one soybean is very much like another soybean of the same grade, one pork belly the same as another pork belly of the same grade, one Bitcoin is the same as any other Bitcoin. There's really no difference. They're interchangeable. And the Commodity Future Trading Commission has had luck explaining that position to courts and getting courts to buy into it. And the SEC, of course, not to be outdone, has found it to be a security as well. Not always. Bitcoin, for example, is almost certainly not a security. It's more of a commodity than the security. But you got to think about what a security is. And the idea of, like, think of a stock. If a company sells stock, we buy the stock, we give the cash to the company. The company goes off and takes all the money from all the stockholders, does something with it, and then returns the value that it's generated if it's successful in the forms of dividends to the stockholders. Well, a lot of these coins that are issued are issued in the same way, especially when they're issuing money, issuing coins to raise money to do something collectively. It doesn't help when somebody like Kick here, Kick Messenger, called something an initial coin offering, because you're guaranteed to pique the SEC's interest when you call something an offering. But in this case, for the Kick and Kin was set up to be sold so that people could take the money and build an interactive environment which would benefit the people who held the coin. It sounded like a stock to the SEC, and sure enough, or security in any case, close enough to a stock, and they were able to convince the SEC the court to back the SEC and get an injunction. So the point is, you have a lot of different rules that are all in place, and you have to comply with all of them. So it takes a lot of legal skill to maneuver in the cryptocurrency space. Next slide, please. And to that end, last year, with crypto interest setting in, everybody's starting to ramp up, because as people are seeing problems, they want to get on board and make sure they're not considered to be slackers. The SEC, 30 different cryptocurrency related enforcement actions in 2022, a huge increase. The Commodities Future Trading Commission bragging about $2.5 billion in fines and penalties that it managed to assess in 2022. The Federal Reserve denying a crypto bank access to the payment system, which, in the wake of Silicon Valley and Signature Bank, seems to be more prophetic than restrictive. But nonetheless, the federals are all over cryptocurrency. And the states, not to be outdone, you have the New York Department of Financial Services telling Paxos to cease and desist selling one of its stablecoins for Binance, the BUSD stablecoin. Next slide, please. Now, for our workout people, how do we deal with this, right? We generally tend to think about liens and how you can enforce things and what kind of things you can pledge. Under the Uniform Commercial Code, cryptocurrency is considered personal property, and it's most likely a general and tangible under current UCC Article 9. It is possible that it could be an Article 8 financial asset in some circumstances. Article 8 is the part of the UCC which deals with stocks and bonds and whatnot, and how brokerages work. The bottom line is that the UCC is not well equipped to handle, because the UCC, the last major update prior to the most recent proposed revisions from last year that we'll talk about in a moment, the last update that was any size was in 2009, 1 year after the Bitcoin paper was published, saying, hey, wouldn't Bitcoin be a cool idea? So the UCC really was not built with this in mind, and so it suffers. There's not been much in the way of successful regulation. There was the attempt at the Uniform Regulation of Virtual Currency Businesses Act. It was proposed by the Uniform Law Association, but most states said, and gave it a pass. Next slide, please. So now we have the UCC trying to catch up. And last year in the summer, they proposed some rather sweeping changes. Now, I should mention, this is not the only changes, but it's not all cryptocurrency. There's a bunch on chattel paper that's of interest to people in our group probably. But its most talked about change is the change for cryptocurrencies. And they don't call them changes for cryptocurrencies. They're calling them controllable electronic records in a new Article 12 with Article 9 changes to match. The reason they're doing that is, as they quite clearly state in the changes, is that they want to be forward thinking, and they don't want to be trying to limit themselves to cryptocurrencies, because who knows what's coming next. They want to think about how cryptocurrencies work and think about that kind of space. So what they talk about is trying to have control of a record describing cryptocurrency as having the control of the crypto itself. That's how you would perfect a security interest in cryptocurrency, kind of like you would in a deposit account. You would have the control aspect. Now, what is control? I got to think about it, because Bitcoin, when people describe it, they describe it as a thing. You always see pictures of a little currency, a little B in a coin or something, but that's not really what it is. It's closer to a number in a spreadsheet. So it's hard to have a security interest in the number 7 in an Excel spreadsheet, but you might be able to get a lock on the cell itself. And that's what they're trying to do here, it's a concept that might be hard to grasp. And so it's going to take some people some deal of time to get a hold of it. But they've got a pretty good handle on how cryptocurrencies work, how blockchains work at least, and have a at least a workable proposal for how this should go forward. Now, of course, no states has yet adopted it, but and it's got to be adopted by a significant number of states to have an effect, but it is coming down the pike. Next slide, please. There's also a little kind of gotcha thrown in. There's in part of the changes that they put in, they said, well, you know, people have been saying we should treat cryptocurrency, cryptocurrency exchanges, we should treat them like brokerages. Because if you think about Charles Schwab, for example, Charles Schwab has never thought to own the securities that it holds on our behalf, right? It's a securities intermediary, and it doesn't have an ownership interest. And boy, wouldn't it be great if crypto exchanges were treated the same way? They were treated so they didn't, were considered owners of the cryptocurrency deposited with them. So I guess the ULA decided to say, well, sure, well, okay, if you guys want to opt into that, you can agree to opt into Article 8 treatment and treat the cryptocurrency exchange as a securities intermediary. And then you'd have the rest of Article 8 goes along with it. Now, only Coinbase seems to, as an exchange, seems to have this provision in their agreements yet, but expect others may follow soon. Now, this comes with pros and cons, and this is the interesting part for people in our space. Yes, okay, if you have cryptocurrency deposited with an exchange and Article 8 applies, then technically it's not as cryptocurrency. You don't own cryptocurrency anymore. You own a financial asset that is a security entitlement to that financial asset held by a security intermediary. New terms that the cryptocurrency people probably have not heard, but these are things that stockbrokers know about. And the nice thing about that is these security entitlements are definitely not property of the broker's estate. It's clear under Article 8 that they don't have an ownership interest. But even though they don't own them, they can still pledge them as collateral, which to me, as a bankruptcy person, means about the same thing. Next slide. So, the comments, the UCC, the Uniform Commercial Code, puts comments in there to help mere mortals understand what they're trying to get at. And to give you an idea of how this stuff reads, this is just one small section of one fairly benign comment as part of a whole series of them. But if you parse out the most interesting words, click once, please. The interesting words here is that for securities, the UCC is saying, well, the risk that investors will suffer a loss is no different than the risk that the brokerage, the securities intermediary itself might fail. The investors are protected against that risk by the regulatory regimes under which security intermediaries operate. So they're saying that, the risk that Charles Schwab would mispledge things that they can't repay back is as small as the fact of Schwab itself failing, right? And we're all protected because all brokers are subject to such regulation of the SEC, they really can't get into trouble. Click, please. Well, that's not true for cryptocurrencies yet, right? There's no regulation such, to speak. So we're getting this little bit of gain under the UCC saying, okay, it's definitely not property of the estate, but you can treat it in ways that are very much like as if it were property of the estate, and you can, pledge against it all legally. So there's not even a question anymore. Is it really safe to say that, brokerage or crypto exchanges should be treated under Article 8 like brokerages? My thought is, probably not yet. Maybe someday, if we decide to regulate them, seriously regulate them, but not yet. But this is what's built into the UCC's proposed changes. Not sure if states will decide to take this portion of it with the rest of them. But this is certainly would make for some interesting situations for workout people going forward if they do. I think that pretty much covers anything we want to cover today on the legal backdrop.
Okay, thanks, Ron. Next up is Deb.
Okay, and I'm going to slow things down a little bit and take a little bit of a step back and not assume that everybody listening knows all of this terminology and exactly how crypto works. And one of the things, following on what Ron was just talking about, the question of, is cryptocurrency property of a bankruptcy estate when the entity holding it goes into bankruptcy? That's a really key and important question. And it kind of goes back to something that people in the space have been saying for years. It's a very common phrase, not your keys, not your coins. Well, what does that mean exactly? So in order to, I would say, do anything to access your cryptocurrency, let's say you own a Bitcoin, and it's going to reside in your wallet. Your wallet may be a cold wallet. It could be something that's basically like a little thumb drive that you keep locked up in your desk. And that's one way to do it. Most wallets, if you want to actually be able to trade or do anything with your cryptocurrency, they're hot wallets, they're connected. And so you'll have an address, it'll be a long string of numbers and letters. That's going to be your wallet, and it's going to be public and anyone can see it. So, for example, when people say, oh, cryptocurrency, it's anonymous, it's also secretive. It is the most public thing you can imagine, because any transfers that happen on the blockchain are going to be public. They're going to be pseudonymous. They're not going to be anonymous. So you're not going to know who owns the wallet, but you can absolutely see the movement of coins from one wallet to another. Okay, great. So then how do you keep other people from just spending your coins that are in your wallet? Well, then in order to actually transfer coin out of your wallet, you have to have the private key. It's an encryption. So you're going to have another long string of letters and numbers, which, a lot of people worry like, oh gosh, what happens if I lose my private key? I could lose access to my hundreds of thousands of dollars of Bitcoin. So what sometimes people will decide to do is, rather than holding their cryptocurrency in their own wallet and having those risks, not just the risk of, gosh, I can't remember where my car keys are. I'm not going to trust myself to remember where my private cryptocurrency key is. But there's also risks of hackers and other cybersecurity risks that, maybe it's better to put all this stuff in the hands of professionals, right? Which, 2 years ago probably sounded like a really smart and sensible idea. Maybe not so much today. So you can put your assets on a centralized platform, a CeFi platform that will hold your assets for you. And so you put it into a wallet on their platform. They hold it. They control the private key. You no longer have the private key where you can just, without any intermediary, just send your coins anywhere, do anything you want. You're going to have to get, now that the people that run that platform have to be involved. And then, okay, well, maybe you want to do more than just custody your coins, because, that's nice and all, but you're not really, making anything of them. So maybe you want to earn yield on them. So maybe you'll put them into an account where the platform is promising, okay, if you deposit your coins, sort of like a bank account, you deposit your coins here, we're going to pay you some yield. And oh, by the way, your bank account's paying you like 0.0001%. Guess what? We'll pay you 8%. And we're going to pay you 8% regularly, no matter what. Economic conditions be damned. And if that sounds too good to be true, then you're probably on the same page as the rest of us already. There are other things that can be done. You can trade cryptocurrency assets with other people. You can actually agree to lend them. You can say, I don't want to liquidate my cryptocurrency because you know what? I bought Bitcoin when it was $250 and now it's 27,000. I don't want to have that taxable event, but I do want to buy a new car. So how am I going to do that? Well, I can put my cryptocurrency on this platform and I can take out a fiat currency loan in exchange where I'm collateralizing my loan with my crypto. I'm still going to own it, I think. Maybe I haven't read the terms and conditions closely, as we'll see, many people didn't, but I'll be able to actually get either a stable coin or a fiat currency loan. I can go buy my car, and then when I repay the loan, I'm going to get my crypto back. No tax consequences. It's great. So all of this sounds really good, but the devil's in the details as usual, and some unexpected things happen when people didn't really read the terms and conditions. And Celsius Network is a really good example of that. And full disclosure, as Paul said at the outset, I do represent an ad hoc committee of customers in the Celsius Network case. I'm not going to talk directly about any of the stuff that my clients are involved in, but I can say generally some things that have happened in the case that I've sort of had a front row seat for. So one of the things that occurred fairly early on in the case is there was a question that was raised as to who actually owns the crypto that people put on the platform. And a lot of people were very shocked to find out, many customers were shocked and horrified to find out that, oh, when I deposited my crypto into this earn rewards account, the account that was going to pay me yield, that was sort of like a bank account. Apparently, if you'd actually read the terms of use, they said, when you do that, you may think you're giving like a loan of your assets temporarily to Celsius. Actually, you're granting them all right and title to your cryptocurrency assets. And Celsius can lend, stake, hypothecate, rehypothecate, do literally whatever the heck you wanted with your stuff. This is now their stuff. And in exchange, you get yield and an IOU to get your stuff back, when and if you decided to withdraw. And that's okay until they file for bankruptcy. And now you're stuck with the issue of, okay, well, can I actually withdraw my Bitcoins that I deposited on the platform, or is all that I have a general unsecured claim against the estate? Now, this was litigated really oddly. The procedural posture was very strange. This came up in the context of a motion by the debtors to sell some stable coin. And stable coin, for those who aren't familiar with it, it's a coin that's supposed to be pegged usually to the US dollar. So, for example, USDC, which famously lost its peg briefly in the meltdown of Silicon Valley Bank, should always be roughly about $1. Sometimes it's like 0.001 more or less, but it should be pegged more or less to the dollar. And so Celsius had some of these coins and wanted to liquidate them in order to fund its bankruptcy case expenses, because these law firms are burning, like $50 million a month. It's very expensive. We should all get into these cases. And there were objections that were raised because people said, wait a sec, these stable coins that you want to sell, those aren't yours. They belong to us, the customers. Now, these objections were raised not by parties that were represented, but by pro se creditors, pro se customers of Celsius. And in the context of this sort of ancillary motion, where the debtors were just looking to sell stable coins, it sort of snowballed into a whole proceeding where the ownership of all of the coins in the earn rewards account, which is the majority of the cryptocurrency that Celsius holds, that was determined. There was no adversary proceeding to determine what constitutes property of the estate. And if you want to talk about David and Goliath, this is a bunch of pro se customers against Kirkland and Ellis. Not exactly what you'd call a fair fight. And unsurprisingly, the unsecured, or rather the customers, were deemed to be unsecured creditors. They were completely steamrolled. It went up on appeal, and yesterday or the day before, I don't recall, the district court said, sorry, this is an interlocutory appeal. You don't meet the standards, and we're not going to allow the appeal. So that's sort of where things are at right now. There's been a determination that, in fact, based on the plain language of the contract, which nobody read before they clicked on it, all of these assets that people thought they owned, their college savings, their retirement money, their mortgage payments, property of the estate. Now, contrast that with the custody program that Celsius had. They had separately, and they did it in a very half-baked way, they had a program where, okay, you're not going to earn yield. We're just going to custody your coins for you. We're just going to hold them, in case maybe you don't want to hold them yourself, because of all the reasons we talked about. So in the custody program, it said, you retain all right and title. We don't keep right and title to your assets. This is just your stuff. The way that they did it was, as I said, a little bit half-baked. They did not have individual wallets that they maintained for customers. Everything was in omnibus wallets and commingled. So everybody who had Bitcoin in custody, it was all in one omnibus Bitcoin wallet. Everybody who had ETH, it was in one omnibus ETH wallet. And so on for each type of coin. And they would try to true up those wallets to try to maintain a one-to-one ratio between what was supposed to be in custody and the assets they needed to back those custody claims. They weren't very good at it. There were often mismatches of up to 25%. And at the time of filing, the mismatch was about 6%. So even though everybody allegedly owned their coins in custody, there weren't enough coins there to satisfy everybody. You could take out your coins, but you could only take out up to 94%. So how did this then get resolved? So the debtors and the committee both raised the issue that they thought that if you had assets in the earn rewards program, which the court has already said those are property of the estate, and then you transferred them to your custody account. So it went from being property of the estate where you were owed a debt, basically an IOU, and then it went to being property of the customer where now you own those assets. It's effectively like a preference transfer, a preferential transfer. And coincidentally, every transfer into custody had to, by definition, be within the preference period. because this whole custody program was set up 89 days before the debtors filed for bankruptcy, coincidentally. So to the extent that the assets in custody had come from EARN, they hadn't just come from an outside account where somebody said, oh, I just want a place to park my stuff. If it had gone from the EARN rewards program into custody, that was what they called the impure custody coins versus the pure, which had never touched the EARN account and were not possibly tainted by a potential preference claim. So eventually there was a settlement that was reached with members of the ad hoc custody group, and this is now being offered to all members, or not all members, but all customers that have custody claims, to take a 27.5% haircut to resolve any preference liability, and then they can take the rest of their assets out, half of them right away, and the other half on confirmation of the plan.
Hey, Deb,
And so
that's a
by-
question for you there. Is that 27.5% haircut calculated on dollar value or calculated on the percent number of Bitcoin or crypto you had? Because that will change it, won't it?
It will change it, and I believe it was calculated based on the coins that they had, because these folks are not getting back the dollarized value of their claims on the petition date. They own these coins, so they're actually getting back. If you had 1 Bitcoin, you're going to get back 72.5% of your Bitcoin. You're taking that haircut on the Bitcoin, and that freed up enough to ensure that everybody else who's entitled to 100% could actually get paid 100%. Very interesting comment that was made at, we had a December 7th hearing in person in front of Judge Glenn. One of the first times I've had to wear shoes to court in a very long time. And one of the comments that one of the lawyers for the committee made after the hearing, when they were discussing what were they going to do about that 6% shortfall, because this preference settlement hadn't been reached yet. And what the lawyer from White and Case said, and I was really surprised by this because, well, for a variety of reasons, he said that, obviously, if we have this shortfall, you own these coins and you'd have a constructive trust claim against the debtor's other assets. So we've got to find a way to make everybody whole. I found that really interesting because I represented a different group of creditors. And when I made the same argument that we were entitled to a constructive trust claim, I met with an absolute wall of resistance. But there was certainly the thought out there that absent a settlement or some other resolution, there was certainly a potential that the custody account holders who owned their coins and who were promised under the terms of service that they held title to their coins, that they would be entitled to assert a constructive trust over assets that otherwise would be available to the rest of the unsecured creditors. And I found that a really interesting perspective coming from committee counsel specifically. So then that, I think, segues into the next issue, which is threatened customer clawbacks. We already have seen custody customers agreeing to settle potential preference liability because of this idea that when you transfer from EARN, out of EARN to whether it's to custody or off the platform altogether, that was a preferential transfer. And that's something that the debtors have asserted, that the committee has asserted. And at a recent hearing, Judge Glenn said, bankruptcy is all about equality of distribution, and really made it clear that he was looking with a very open mind towards clawbacks of customer assets. And I think that could have an enormous impact on the industry. We're talking about, is there a future? If you want to say, is there a future for centralized finance, for C5, for these types of platforms where that if they go into bankruptcy, you might only get paid bankruptcy dollars. And if you did manage to get your stuff out, they might try to take it back from you. I don't see a lot of people being real excited about depositing their cryptocurrency with entities like that, with that level of risk. And I've heard this on social media. I've heard this from client groups, both in Celsius and BlockFi and FTX, that if this is the path that the US bankruptcy courts are going to be taking, it's really going to just completely drive this type of entity out of the United States. If you're going to have a lender, an exchange, a whatever, it's going to be offshore, where I think people at least have the perception that that clawbacks are not going to be as much of an issue. And some really interesting things. Could this be ordinary course? Is there an ordinary course defense? This is literally what these platforms are for. You put your money on, you take your money off. It's like a bank, right? What could be more ordinary than that? And Voyager, back a few months ago, I think last October, was saying, oh, was it October? It might have actually been earlier. So when they were still thinking that they were going to sell themselves to FTX. And FTX was buying and burying all of the retail customer clawback claims. And Voyager and trying to justify why there was no dollar value assigned to that. Like, why were those claims worthless? Saying, oh no, this is ordinary. This could not be more ordinary. This is exactly what the platform is for. These transfers are completely protected, even if they were potentially preferential. These are ordinary course transactions. Full stop. Okay, then also Voyager, just like a month ago, oh yeah, you know what? We should carve out at least 32,000 plus of these preference claims, and they should be pursued against customers because they do have value. So, I guess your tune changes when your buyer goes away. Might be the answer. So are these ordinary course? Maybe. I think there's an argument there. I think there's definitely an argument under Section 546E, the safe harbor. If you can go through and track and meet all of the boxes that you have to check, in particular, are these things securities contracts? And are these transfers in connection with securities contracts? And you've got the SEC saying, yep, earn rewards, that's a securities contract. You've got the state regulator saying, yep, definitely securities contracts. And if you can get the court to agree, yep, definitely securities contracts, I think you're at least halfway there to a 546E defense. So if that defense is upheld, I think that may blunt some of the concerns about the impact that clawbacks could have on this nascent industry. But I think even if they're pursued, if people have to spend millions of dollars defending themselves and they have that risk and uncertainty, I think it's going to have a devastating impact on the viability of CFI in the United States. And that's what I got.
Thanks, Dan. All right, Ryan, you're up.
Yeah. So for those of you that don't know, I'm going to give some background on Three Arrows Capital, Voyager, BlockFi. So Three Arrows Capital, Singapore-based crypto hedge fund, founded in 2012 by Kyle Davies and Su Zhu. Its early on focus is actually pretty interesting. It was for arbitraging emerging market foreign exchange, and then that later shifted into derivatives and cryptocurrency. More recently, though, their last public statement claimed they had 18 billion net asset value. They borrowed billions from over 20 large institutions, and they lost around $3 billion from 2021 to 2022. But it should be noted that these losses were driven mostly by investment decisions, not the market volatility. And that will really come to fruition later on as we get into some of my slides. The British Virgin Island courts ordered to liquidate in June, and there's 3.5 billion in creditor claims. You can go to the next slide, Paul. Again, Three Arrows Capital was more of a self-inflicted crisis. It wasn't driven by that market. It had large trades in Grayscale, Luna, and Stake Ether. We touched a little bit on Grayscale and Terra Luna on our last webinar, but just to give some more background, Grayscale is a digital asset investment product. It exposed investors to Bitcoin via security of GBTC without the hassle of purchasing and managing Bitcoin. But the issue with this was investors could only sell after that 6-month lockup period. And when the premium flipped negative, investors kind of got stuck holding on until that lockup ended. And in Three Arrow Capital's case, they held over 6% of Grayscale's 3.6 billion trust, so it impacted them negatively. The stable coin, which is UST, promised to keep, as I think Ron or Devin mentioned, $1 of value regardless of the market volatility, and they promised their investors high yields, sometimes up to 20%. And what happened with Terra Luna was UST and its sister company crashed when the yields weren't met. And in response, the Luna Foundation raised $1 billion to pay UST yields. They borrowed $200 million from Three Arrows Capital. However, the Luna Foundation Guard failed shortly after this. So it was essentially unsuccessful. And you can go to the next slide. The 3 Arrow Capital was a death spiral again. It was catastrophic for the crypto lenders. I mean, BlockFi, Voyager, Celsius, many of the lenders have filed bankruptcy themselves, and the damages from 3 Arrows Capital are still unfolding. You can go to the next slide. I'm going to talk a little bit about Voyager. Voyager was a crypto brokerage company founded by Steve Eldrick. At its height, it had 3.5 million users in 2022 and 5.9 billion in assets. It's worth noting that it skyrocketed in users from 2020 when it only had 120,000. So it really became popular in 21 and 22, and then it's backtracked since then. But it was a crypto trading platform that allowed deposits and trading of crypto assets. Depositors would earn yields for holding certain amounts of crypto assets in the Voyager ecosystem, similar to some of the other companies that had its own system. And then they would lend the crypto to major institutional players, funds, etc. Debtors would use the additional leverage to increase long or short positions or make investments. But when the crypto market plummeted before the debtors could make their payments to Voyager, this combined with the classic bank run scenario from depositors led to the ultimate downfall. And then it's worth noting, Voyager had a unique marketing issue with the FDIC where I myself haven't seen it, but many individuals were claiming that Voyager's marketing campaigns indicated that they were backed by the FDIC, and the FDIC actually got so frustrated with this, they issued a cease and desist on all marketing, and the language had to be revised. Again, I didn't see anywhere where the FDIC was claimed to be backing any of the Voyager crypto, but still people were claiming that that's why they got sucked into it and they were frustrated. You can go to the next slide. So this one just shows a brief timeline of what happened with Voyager. So 3 Arrows Capital wasn't repaid. Then we got to December and Binance won the bid to buy the assets, but now it's blocked. So where do we stand now? I think most recently, I think there was something about Paul Hastings declining to be the counsel. And then Paul, you can go to the next slide. So we'll jump into BlockFi. BlockFi, for those of you that don't know, is a digital asset lender. It at one point was valued at $5 billion. It's a competing trust to Grayscale, and it's similar to Robinhood. It offers zero fee buys and sells and sold transactional data to firms. It was really hit hard when the New Jersey Bureau of Security looked at its accounts and said, these are essentially unregistered securities, and hit them with a fine of $100 million. It had assets held with crypto lenders, and it all played a part of its downfall. Its big thing was it got hit by debtor defaults, and they were fortunate enough at BlockFi to liquidate their 3 Arrows Capital collateral, where Voyager was considered unsecure in this case. And then you can go to the next slide. This is just a timeline of what happened with BlockFi. Really took off, went quick. In July, it liquidated its 3 Arrows Capital, and by the time November rolled around, it filed for Chapter 11.
One thing I'd point out about BlockFi that I thought was really interesting is right before they filed for bankruptcy, at possibly the absolute nadir of crypto prices, they took all of their crypto that was not locked up in custodial accounts and they liquidated it. They monetized it at the lowest possible prices and locked in those losses. And that was an extraordinary decision. Before there had been any determination of the ownership, whether those were even property of the estate. So just something really interesting going into their Chapter 11 that I think is different from some of the other cases, that at least they're still sitting on crypto and they've had some recovery in prices. Not so with BlockFi.
Yeah. And Paul, I think you're next.
Okay, thanks, Ryan.
Yeah.
So I'm going to talk about FTX. So you've heard about FTX a couple different times. You're going to see it's a very similar thread to a lot of the other bankruptcies and a lot of the other issues that we're seeing. So FTX is actually the third largest cryptocurrency exchange by volume. It's mainly FTX.com that you see on the screen is global, and it's mainly so big because it's one of the major cryptocurrencies used around the world. It's also here, and it's called FTX US. And it's been expanding around here, or it was expanding, I'm sorry, with acquisitions in Canada and Japan. Its CEO, Sam Bankman-Fried, was called the JP Morgan of cryptocurrencies, or another term that I've seen is the next Warren Buffett. And another key point is just to remember is FTX and Alameda Research were closely tied together, probably as what we'll see it too closely tied together.
Paul, he was originally, JP Morgan, and now his name is going to be synonymous with Ponzi, which was another name. It wasn't, there's a guy who ran a scheme. I don't know, Ponzi / SPF is going to be the new lawsuit, maybe. Who knows?
Have an SPF term. So what happened? So cryptocurrency began losing value, and it pressured cryptocurrency companies. Now, this is not new. Crypto winter that we're calling this, Deb pointed out before that this has happened multiple times before. This wasn't necessarily new. The new part is that when it was losing value, that someone leaked Alameda's balance sheet. And they were kind of set up a little bit different, that they mainly had what we're calling lightly traded coins. And these were something different than just Bitcoin in the past. So as crypto lost value, Bankman-Fried was attempting to support all these struggling crypto companies by doing some exchanges from his coins into cash, which we'll see in a minute was very interesting. And then Binance got involved, and I left the dates on the slide because it's kind of interesting. November 7th, they announced they would offload all of FTT. Notice I changed the acronym. That's actually their coin that they used. So it's a coin internal to FTX. Then the next day, they entered into a non-binding agreement to purchase FTX, the company. And then one day later, they terminated the agreement, citing mishandling of customer funds. And a lot of this was, I mean, you could probably understand they got in and they saw what the balance sheet was and they went, oh my gosh, there's no way I'm going to buy this. So, and then on top of that, there was also reports of missing fund surfacing. I saw something that was like the day after they filed Chapter 11, $500 million, almost $500 million in customer funds went missing, which is pretty significant, pretty interesting. So where it stands now, 8 criminal charges, including wire fraud, conspiracy to defraud the United States, allegedly lied to customers, investors, lenders.
Paul, I know that was up to date as of 2 days ago, but I think it's now they had another charge, right? Because of the bribery charge. Yeah,
there's another one. It's I was going to say that at the end here. It's a 40 million bribery charge to Chinese to unfreeze his assets that were related to his crypto business in China.
So you have a little counter on the side. You've gone 2 days without an indictment. Oh, reset. Here's 0 days since the last indictment.
It's pretty interesting, like a soap opera. So Sam's defense was he passed off the blame as oversight. He said he knowingly didn't commingle funds, and he said, quote, "I didn't know what was going on," which says it all. So what was the root cause? Why did this happen? So I mentioned FTT on the first slide. It's as a currency, it was internal to FTX and it was lightly traded. And another key part is he received cash loans on this FTT. So when you had massive sales on FTT, it ended up causing this currency to collapse because it basically had no value. Or the value was, it's almost like it was a fake value because it was internal. Was it worth a penny, or was it worth $100, or was it worth $1,000? I mean, it didn't have any value. So the root cause on this, and this is part of this is from a consumer perspective as well. It's poor crypto knowledge, and Deb was kind of hinting on this earlier. It's customers aren't reading the fine detail in a lot of this. And then knowing that a lot of crypto was on margin, there was loans and purchases. A lot of it was highly leveraged, and it was expected to be paid off because the FTT kept going up. And so as it was going up, customers felt that they could constantly pay this off and be on margin and not have any issues. But at the end of the day, it looks like, and this is something Ron mentioned, it looks just like old-fashioned embezzlement. Okay, so now we're going to talk about a future outlook, and this was supposed to be more of like a roundtable. I think a couple key things that we had, and maybe we'll just take one at a time and just talk through it. So the first one was something that Deb had mentioned, that the SEC continues to regulate by enforcement. Deb, did you want to expound on that at all?
We go into that.
Yeah, I
There's a
mean,
question up on the
Ron
panel.
had talked about saying, oh, there's all of these rules. I'd say there aren't all of these rules, and that's part of the problem. So there's a lot of confusion, or whether true confusion or feigned confusion. Well, how are we supposed to know what we're supposed to do to comply? There are no, and the reality is the SEC has not sat down and made rules. And, oh, you should be able to figure it out. You should know. You shouldn't be surprised by this. But the reality is, and I think Coinbase is probably the starkest example, you now have the SEC going after Coinbase, a publicly traded US company that has been in plain sight. They have not been remotely non-transparent about what they're doing. The coins that they list, the products that they offer, the services, who can invest, all of this, it's all been out there. The SEC has allowed this ecosystem to grow. They've allowed people to invest billions of dollars in it. And I'm not opining on whether it was right or wrong that should have happened in the first place. But the point is it did. And now, after years, yes, oh, actually, we think that's all illegal. I mean, what the hell? That is not the way that regulation is supposed to work. That is not the way that businesses are supposed to have to try to operate to do something that, so everything that they can tell is perfectly legal, and doing it under the watchful eye of the SEC, only to have the SEC turn around and say, oh, actually, yeah, we changed our mind.
Well, the alternative view on
that's just
that
not
is
appropriate.
if you're driving, everybody's driving at 75 miles an hour, 80 miles an hour on the speedway, and so, in a 55 zone, and the cops show up and like, but you've been allowing speeding for years. Well, you should continue allowing speeding now because it's grandfathered in.
Ron, that's an absolute straw man. That analogy just doesn't work. It's like if you went to the cops and you said, by the way, I'm going to be driving on this road at 70 miles an hour for the foreseeable future. That's what I'm going to be doing. Hey, cops, are you okay with that? And the cops are like, yeah, okay. And then
there are letters from the
years
SEC
later,
saying they're
after
okay
you
with
built
this.
an entire business around driving 70 miles an hour. Then the cops come back and say, oh, we changed our minds, without any sort of, and it's not even just, could they change their mind? Can the government step it? Can Congress say this is illegal? Can the SEC make rules and say this is not going to be okay? Of course they can, but there's a process for that. You can't just do this by enforcement after you've said things are okay and then, oh, we changed our mind. Like that's not how that's like a banana republic. That's not how the United
Reasonable
States
minds can
economy
disagree
is
on
supposed to
that
work.
position. Let's just leave it at that. I would say that the idea that people find a new way to violate this, the law, and then go, oh well, I didn't know. Yeah, and people take a while to catch up because they don't understand, because the SEC didn't understand cryptocurrency for a long time. This is relatively, don't forget,
The SEC still doesn't understand cryptocurrency.
Yeah.
well, I know, and that's the thing, is this thing's only been around since 2008 was when the first idea came up that this might be a cool thing to do, and that was just Bitcoin. That was not the other ones, right? So now you've got, this whole industry has sprung up in the last 15 years, and the fact that the SEC is not quite as fast to enforce. I'm going to stick with my speeding analogy. You found a new way to exceed the speed laws, and the SEC said, there's certain things that are out there. The Howey test has been around for a long time. Now, would it have been easier and clearer if they said this applies to cryptocurrency also? But if I find a new way to kill somebody, it doesn't matter the fact, it's still killing. I'm just pointing out there's ways for people to have figured this out if they had wanted to. They didn't want
There's
to.
also
because
a
there's money.
rulemaking process. There's due process. There
is due process.
What I'm saying is that we as a society, and that our government and our regulatory agencies, we are shooting ourselves in the foot by going about this in a way that is so completely backwards. Like, if you want to make rules to regulate these things, then make the rules. Have notice and comment. Let people who actually know about this stuff speak up.
So the alternative is, because it's going to take
regulated.
us a few years to make the rules, we should just simply stop it from happening in the first place. Nope, sorry, you cannot have crypto until I have a chance to figure it out. Because obviously, if I let you have it now, then I'm going to be grandfathered into having let it happen. I think this is inevitable. This is how people learn and grow, and there's going to be some pain along the way.
Let me jump in here. I see this as a new industry, and new industries can be messy. And that's really what we have going on. It's messy. All right, let's move on to the next one. So Another key thing that, Deb, that you mentioned that we probably should talk about a little bit more is the clawback of customer withdrawals.
Mhm. Yeah, I think that, and here's part of the problem. And I don't know if it's a problem of the bankruptcy code or if it's a problem of other regulatory regimes, but you have these debtors that are they're kind of shaped like stockbrokers or banks or, some other financial institution, to Ron's point, maybe you need to opt into Article 8, maybe you should be treated like a stockbroker, but you don't have the regulatory regime around it to support this. So you have a real round peg, square hole, square peg, round hole, whatever the analogy is. You've got this problem where you have people who have treated these entities like the things that they look like. They look like stockbrokers. They look like the New York Stock Exchange. They look like banks. And then when you try to get your assets out, you realize, oh crap, these are actually just like regular Chapter 11 debtors subject to all of the same rules of Chapter 11. When, I'm thinking I had to have SIPC insurance, I ought to have FDIC insurance. There should be something to protect me as a customer. So you got this real mismatch between how these entities function and the regulatory and legal regimes that they're operating within. So, do I think that customer clawbacks are going to happen? Yeah, because that's what all of the lawyers have said, and I believe them. Do I think it's going to have a devastating effect on CFI in the US? Yes. And do I think it's going to drive some kind of innovation in how do we address this issue? Maybe the way that Ron was talking about earlier, to have some kind of protection so that when you do deposit your assets, you have some reasonable chance of actually getting them back again, even if the platform goes belly up.
Now, to be clear, I wasn't talking about Article 8 as the method of that protection. I'm saying that's what somebody put out there. And I think at the moment, it's a really horrible way to go. It fits people's viewpoints, but it doesn't fit their viewpoints 100% because now it takes them closer, takes an exchange closer to what a stockbroker looks like, but without the regulation that makes stockbrokers safe. So,
and my point is, if you're going to look like a stockbroker, you need to have something around you to make you safe. There's got to be a safety net.
You've got to have all the SEC regulations, and I think it's got to be absolutely clear that if you want to operate like that, then these are the things, and that means also there's limitations on what you can tell customers, which means a lot of the communications that cryptocurrencies put out are going to have to be scrutinized because they tell people a lot of things that lead people to think things that are not true. And I think, to me, my personal belief is if you want to go after individual, mom and pop customers, there's a lot of regulation that comes with that. You want to deal with sophisticated people, let them take it on the chin. If they want to do that, that's how it's been in the past. But if you want to go after mom and pop and advertise on the Super Bowl, this is a quick way to get rich. Well, then you have to be subject to a lot of monitoring of what you tell people. And right now we don't have any of that, probably because we have a free market, because we allowed people to go around and grow and build these industries. Yeah, the regulations catching up, but the regulations been there. What SEC's regulate, what the Howey test people. It's not like these cryptocurrency companies have not had access to funds. They've had lots of money they could have invested in trying to figure out, hey, am I doing something that could get me in trouble? And the answer is they said, yeah, and they probably steered their way as much as possible to avoid it. So that's just,
well, I mean, a lot of them, especially since the February 2022 settlement between BlockFi and the SEC, have cut off access to US non-accredited investors to some of the riskier products, like the yield product. So, I mean, and one of the problems is if you were already there and you had been, misled into thinking it was, oh, this is as safe as a bank, this is better than a bank. So you were grandfathered in, but at least, they cut off new investments in. And if you took your assets out and you were a US non-accredited investor, you couldn't get back into the yield account. And all of these, completely, non-US regulated, the international arms, the FTX.com, which is not part of the US, the BlockFi International, that's not part of the US, Binance. If you're a US customer, you're not supposed to be able to invest there. And of course, if you read the CFTC's complaints against Binance, one of the things they were doing was like sort of coaching people on how to use VPNs to get around that restriction. So, to some extent, you can't really protect people from themselves, but right. I think there's got to be some greater effort has to be made to try.
Yeah, definitely. All right, the final item here was bank failures, and we probably could do an entire webinar just on what's happened with the two banks that failed recently. But the two in particular were I think so. Yeah, it was Silicon Valley and then Signature Bank, but they were both supposed to have.
And Silvergate.
Crypto.
Silvergate was the first one.
Yeah, you could probably mention Silvergate as well, but they were
Well,
both
that was the one
mentioned.
that was the banker to the crypto industry.
Right. So they were both supposed to have cryptocurrency in their assets. But that's not the reason why those two failed. Those two failed because really of a gross mismanagement by financial institutions, not just at the bank level, but all the way up through regulators at the state level and at federal level. And it had a lot to do with how they were investing the assets that they received from customers. So there's still a lot going on that. There's going to be congressional hearings on what actually happened with those two. And and Deb, back to the Silvergate one. Yeah, that's kind of a different one. I was just focusing on actual the two of the top 3 largest bank failures ever were in the last, whatever it was, 3 weeks. And it wasn't because of crypto, it was because of how of interest rates on how they increased and how these banks handled that.
This deserves a couple of quick
Can I
comments.
push back on that a little bit?
Well, before we talk, let's just talk. First of all, when we say the largest ones ever, part of that has to do with money because when after inflation, unless they've adjusted for inflation, then the fact that anything happens today is going to be bigger than anything in the past, simply because dollars are worth less than they used to be, and so there's more dollars involved. And as far as the mismanagement, let's make it clear, it's not like the banks have been accused of doing anything in the sense of buying risky investments, in the sense of they were buying treasuries, but the problem is they were buying very long-term treasuries, and they all bet heavily on the idea that the Fed would never raise interest rates.
Yep.
And of course, then the Fed did raise interest rates, and a prudent bank would have hedged those risks, and they didn't, because they wanted to chase rewards and yield, and that's when they all went down. Because if they had not had withdrawals, they would have been fine. They would have just rode them out to maturity and done fine, but they didn't have. They had withdrawals and they had to sell and lock in their losses. And so that's what really this is a story about: banks failing to anticipate the end of lower interest rates and the fact that they would change quickly. I
think you mentioned, but I think you're not focusing enough on one of the points there. It's not just rising interest rates, because if depositors had said, okay, fine, we don't really care, we like this bank, we're going to leave our deposit here, like a lot of people are doing at First Republic,
Right.
for example. But when you have a lot of really computer savvy, interconnected depositors, big depositors that are all on like group chats together, and they're all in the same industry, and that industry is in turmoil. And they all decide as like a herd of lemmings to hold their deposits, you're really screwed. And the rising interest rates were part of that. But the other part of it is the nature of the depositors. If you have, complacent depositors that are not all, talking to each other, when you've got a bunch of VC firms and you've got all of the guys, on WhatsApp together going, oh God, tell all the CEOs of your portfolio companies we got to get out now, you're going to have a run on the bank.
Yeah.
That's true.
And that is,
and that'll kill any bank.
Yep. And it could be if it was a housing, if that bank had all housing loans, it could be the same thing. It's not really a.
It was the same thing years ago, although they got bailed out in 2008.
Exactly. That hence the example. Okay, so let's jump to questions. Ryan, I think you had one. Did you want to bring that one up?
Yeah, the question I had was, what is more challenging, managing human capital, which is not shown on the balance sheet, or cryptocurrency? I think both of them are challenging. I mean, human capital, like we've kind of discussed throughout the presentation, is an issue both for customers, investors, as well as the institutions themselves, as we heard people claiming, I didn't know what was going on, and also on the regulatory side, where there need to be rules in place or processes that we can follow so that we can hold everyone accountable. So for me, I mean, I would push towards human capital. I mean, you need to educate, we need to have systems in play. I don't know. What do you guys think?
I'm not sure I even understood the question, to be honest with you. As far as human capital is concerned, if you're talking about, managing how investors think, that's one story. If you're talking about managing the employees of these companies as they go under, that's another question entirely. So I wasn't quite sure. I took the way you just translated. I think your answer makes sense. But I'm saying, as far as managing human capital, if there's a question about people fleeing, like
I think it's people.
IT people fleeing the business, I'm not terribly worried about that, because if money comes back, I think the people will come back. I'm not too worried about labor reallocating in this space. It's a very nimble space. As a matter of fact, it's too nimble for law to keep up in many cases. But
Yeah, I mean, one thing to look at it, it's the crypto winter is almost over. If you think about it, it's like crypto's been up, what is it, 80% this year? I mean, it's just suddenly everyone is not as worried about crypto being down because they've seen such an increase. So it's amazing how many things suddenly don't become an issue when the price keeps going up.
there's another follow-up to that question about how do you value human capital? Again, I'd ask to define what you mean by human capital, because I think, I can't answer the question if I don't understand the question. So I'm not sure which human capital are you wishing to value, the employees involved, the goodwill toward the industry of the public as a whole. I mean, there's so many different ways to measure that I don't have an answer. I will, to Paul's point, mention that that while first of all, this current crypto winter may be ending, and I suspect that winter is coming again. I don't know when, but there's been winters before. Many ups and downs in this market. This has just been the most recent one. I suspect that there'll be another come to Jesus moment when people have another reckoning. It'll be triggered by something else. But nonetheless, to the next point earlier, the blockchains are still working. So the underlying technology still functions. What people do with it and how much they invest in it, will they use it to do transactions, like and use Bitcoin to buy at 7-Eleven, or continue trying to push for extreme long-term investments for their 401? I think we have to figure out what the best purpose is for it, I think. And then once we do, we might have a better chance of regulating it. Right now, it's it's all things to all people, and that's what lends itself to fraud.
Well, also the fact that there's not really a real world use case for it yet, by and large. There's the purpose of having crypto is to trade crypto.
That's right, and as long as that's the case, you're not going to have much. It's almost impossible to regulate. It's like you're regulating baseball card trading. I mean, its value is going to be what it is. But it's coming along. Like, I understand Strike is coming along, according to Nick, and that's this thing that's going to allow people to use cryptocurrency in their wallets to go off and literally on their phones do a transaction with 7-Eleven, and 7-Eleven gets the dollars. So you could immediately transact, and so it becomes more like the cash alternative that it was aimed to be, as opposed to this investment vehicle, which is sort of what's causing much of the difficulty.
Yeah, I suspect we're probably maybe 10 years away from sort of widespread adoption of central bank digital currencies, and I think it'll be interesting to see whether that displaces Bitcoin, ETH, and other cryptocurrencies.
Yeah.
So we have a follow-up on our question. I guess the question was, how do you value human capital? It says sports values human capital and Hollywood values human capital. And how do you value it here? In sports terms, that would be athletes. And I can understand how you evaluate. I assume that's what you mean by human capital there. For Hollywood, that would be actors. And I can understand how you value them. You look at the potential draw that they would have in entertainment revenues, whether it's ticket sales at movie theaters or venues. I still don't know how that question relates to crypto, because if you're trying to value of human capital, like SFB bringing what he brings, which was fraud, or you're talking about the people who are innovating, or you're talking about the day-to-day worker bees who are making
innovators.
Sure the blockchain works.
Ron, why don't we go back to the SBF example?
Yeah.
Because I think one of the things that a lot of investors did was they said, oh, look, here's this kid, he's got crazy hair, he wears shorts in inappropriate circumstances.
Yep.
Clearly he must be a genius, let's give him billions of dollars. And that's how they valued him. And the issue was that many of these startups, and it's by no means limited to FTX, they're sort of cult of personality. They are driven, they're very founder driven, they're very personality driven.
Right.
Alex Mashinsky on YouTube talking about unbank yourself. And you have, and so the human capital piece is actually huge in attracting people to invest in these things. And I would say, if you're looking at potentially investing in crypto, you should be valuing human capital with a huge grain of salt. and looking instead at things like, what's this person's experience in finance? Have they ever served as a CEO of an actual company before? Do they know how to make widgets?
A
Widgets would
bank.
be really good. And don't just look at the personality, look at the balance sheet. I mean, going back to the whole FTX implosion, this was sparked. Ian Allison at CoinDesk published, the big leaked Alameda balance sheet, which then triggered a Twitter war between CZ at Binance and SBF at FTX. And CZ, I'm going to dump on my FTT. FTX tanks, gives CZ the opportunity to come in. And honestly, this is my own personal conspiracy theory, so take it for what it is. I think this was a deliberate effort to tank FTX so that he could come in and buy his main rival cheaply. But then he was kind of like, the dog that caught the bus and was like, don't know what to do with it, because it took him about 2 hours with FTX's alleged financial statements, which remember that's what Matt Levine called an Excel file full of the howling of ghosts and shrieking of tortured souls. Like, if you take a look under the hood, if you're not just looking at the human capital, but you're actually looking at what restructuring professionals should be looking at, which is the numbers, it takes about 2 hours to realize, like, this thing is beyond help and stay far, far, far away from this. So that's what I would be my answer to human.
I agree. And the comment that just followed up on the same questioner's person saying, well, the most valuable asset of any company is human capital that's not shown on the balance sheet. Why? And I would argue that that's not necessarily true. Human capital is a portion of anything. But if you look for investments, for example, aside from Warren Buffett, who seems to have his own personal brand in the sense, of his insurance company, most of the time that what makes a company long-term successful is its processes, and that which channels, the human capital is part of it. In the sense of making these things work and getting ideas and coming up with the next best thing and all that kind of thing. But it's also the idea of having an institutional way of storing knowledge, of transferring, raw assets into materials. So it's when you look, for example, at a bank, you don't just look at the human capital, you look at what's on the balance sheet, because the human capital can only work with what's physically there. Maybe in startups, where all you have is a smile and a promise, you have to look for the human capital. But for many of these companies, when they get big enough, it's if you're at the point where a Twitter war can devalue your entire company in an afternoon, you're not stable enough to be an investment, in my mind. That just that's my personal 2 cents.
I think we've exhausted that.
Yeah, I think so too. Well, our comment has continued, and I'm not sure how to answer that. I'm trying, but I think I'm going to end this.
Ron, you did great. Yeah. Any other questions? Ryan, or no others?
No.
Okay. Well, this was it. Thank you, everyone, for joining, and hopefully we see you at other events.
Thanks all.
Thank you.